All right, guys. So welcome. Thanks for joining this webinar. So we have Lewis and myself. I'm Juan Pablo. So some of you guys are familiar with me, but I'll just go ahead and share my information, my background, because I like to brag on myself, pat myself on the back. But I have 63 units in my portfolio, and I've acquired a great majority of them through using creative financing as well as partnerships. And I'm looking to obtain additional rental units in my portfolio this year with the help of partners, so that way we all can make money in this endeavor. So Lewis and I came across this 58 unit apartment building. So it's a mixture of a 56 unit apartment building, a 2-family, as well as 3 vacant lots. Okay, so this property is a yield play. A yield play is where you acquire property that's currently dishing out cash flow. There's little to no repairs needed. So there are some repairs which we'll go over, but they're primarily just cosmetic repairs, not major repairs. Okay, so it's already dishing out cash flow. It's already yielding cash flow day one of closing. So this is a safer investment, and that's what we like to do in regard to a syndication. And with the syndication, the main thing I like to do is provide you guys with education. I want you guys to be privy to everything that's going on, the numbers, how it currently stands, as well as the projected numbers based upon our management style, as well as our exit strategy. We like to outline all those things up front, as well as leave room for your Q&A for questions and answers. So with this property, it's Lewis and I, we looked over all the numbers, and we have a plan of action. So if you see on the spreadsheet, there's several scenarios that we're going to implement, and this is our preferred scenario under the summary tab. We also have profit and loss, acquisition costs, the exit strategies, and the returns. The 2 tabs that we're going to focus on today are the summary tab, as well as the returns tab. So you can see how much bang you're getting for your buck, so to speak. So let's go ahead and get into some of the summary. So I'll go over some of the material, and then I'll pass the ball to Lewis so that he can share with you additional information. So as I stated earlier, this is a 58-unit apartment complex in Syracuse, New York. The asking price, let's assume that we get it for the asking price, because of course we want to see if we can talk the seller down on the purchase price. But the asking price is $2,050,000. Okay. And one of the things I like to do when buying a property, when negotiating, I like to do the give and take. For the ideal situation, I want to have terms. Meaning, hey, seller financing, I want credit for the repairs, all that good stuff. And normally the seller may say, okay, well, I want the certain purchase price. If you want me to hold a note, seller financing, which is a second mortgage, and if you want me to give you a credit at closing for much needed repairs, then at least honor my asking price. So there will be a give and take, but we always try to buy with built-in equity so we can do a cash out refinance within year 5. Okay, so I'm just going to go over some of the basic information that you can clearly see. The price per unit, that's pretty much the price per door, is about $35,000, which is not too bad. That's pretty much the top high end that I like to pay for a property. Anywhere between $25,000 and $35,000 per door. Okay, earnest money deposit is $20,000, which is 1% of the purchase price, and then down payment is roughly $266,500. And as you see that in the blue, this is a 13% down payment because we were able to negotiate a 7% seller financing. So we have 80% coming from the bank as a mortgage, 7% coming from the seller, and the other 13% we have to bring to the table. So that's not it. So of course we have to bring 13% of the purchase price, which is again $2.05 million, but we also have to bring additional capital to the table to fund the soft costs. The soft costs are costs such as the appraisals, property inspections, attorney fees, traveling expenses to take a look at the property, and so forth. Just the upfront costs, that's what soft costs are. And then of course there's closing costs as well. Attorney fees and pretty much when you close on a property. So you guys are pretty familiar with that. So it'll be a little bit over 13%, which we'll need, and we'll get into that later once Lewis starts to take the ball and run with it. So we have the first mortgage of $1.7 million with one of our preferred lenders. Okay, and the interest rate is 5.25%. So generally with this loan, we do not need you to bring your W-2s or your tax returns or your FICO score to the table. Lewis and I have that covered because we have stellar credit. Not to brag, but we have excellent credit. Both of us over the 700s. So we're going to be personally guaranteeing the loan. Okay. So when it comes to all that paperwork, we're going to be doing it. But we will need your cooperation in regard to if the lenders do have any questions or if the attorneys need some information, like for tax purposes. Whether you're buying the shares and whether your personal name or some business entity, they will need either your social or EIN so that we can create K1s at the end of the year, okay, for investment purposes, for tax purposes, I meant to say, okay. But generally speaking, Lewis and I will cover the mortgage and deal with the mortgage broker.